This is Rob Rowan with CFA Society New York. Welcome to our podcast, Compound Insights. Today we're talking about the evolution of the regulations over insurance companies and how it has and will affect their investments with Amnon Levy. Amnon is the Chief Executive Officer of Bridgeway Analytics. And Bridgeway works with investors to improve efficiency and income generation by bridging practitioner needs. He has a passion for best-in-class analytics and has led the development of quantitative solutions used by the investment management, lending, risk, ALM, treasury, and financial reporting functions at over 200 banks, insurance companies, pension plans, and asset managers. Amnon has also led numerous initiatives, including the 2021 redesigned NAIC regulatory guidelines for life insurance company holdings. So he is definitely the person to speak with about regulations. So Amnon, thank you for being here on the podcast with us.
Well, thank you, Rob.
So I'd like to start with if you could give us a relatively high altitude look at where you see the regulation of insurance companies right now.
It's a complicated time, Rob. The regulatory framework that governs insurers was rolled out in the early 90s under the RBC, or risk-based capital framework. That framework on the investment side was originally rather coarse. It only had 6 delineations across credit segments. AAA to single A was assigned a single level of regulatory capital. And it didn't differentiate across different types of credit, whether it's municipal credit, structured credit, or corporate credit, or for that matter. The 2021 revisions increased the granularity on the credit side from 6 designations to 20, roughly in line with the alphanumeric designations that rating agencies now have.
Okay.
But it still doesn't delineate between different types of credit, different credit classes, whether, as I pointed out, muni or structured, that often have quite different risk characteristics. It doesn't differentiate across credit with varying maturities. A 3-year credit and a 30-year credit is treated the same from a regulatory capital perspective, as far as life companies are concerned, for example.
As you and I both used to work at rating agencies, that just makes rating analysts freak out a little bit. Right? And that is maybe worse than the, I don't know, from a credit rating perspective, what do you think? Is that worse than treating all munis the same? 3 to 20 years of maturity? I don't know, it's a hard call. But, so is that where we are right now with regulatory environments?
Yeah, so right now the regulatory environment is having regulators really explore the possible need to differentiate across credit segments. In particular, there are a number of groups within the NAIC that are exploring differentiating across structured and, in particular, CLOs. There's been a tremendous increase in the holdings of CLOs, the acknowledgement that CLOs do have differentiated risks is something that regulators have an eye on in terms of the possible differentiated treatment.
Okay. And now maybe we could take a look at the other side, the Euro side. How has the regulatory direction been there over that same time frame?
Fascinating comparison between Europe and the US. If we think about how regulation interplays with capital markets and investment strategies, let's keep in mind that insurers are massive players in capital markets, the largest single player in the US. The regulatory environment in the US, very different from the regulatory environment in Europe. The European structure really results in an equilibrium where you'll see insurers focused much more on investing in sovereign credit. And you're not, the fact is corporate credit hasn't really developed as to the extent that it has in the US. And other aspects of fixed income capital markets haven't developed. To a large part, I attribute that to the regulatory environment in Europe and the fact that as a result, insurers don't have as much of an appetite to hold those sorts of instruments. The role that insurers play in fixed income markets in Europe really had them steered towards holding sovereign credit. And that has an interesting result of insurers really being much more front and center when it comes to the role they have in funding deficits. And that winds up really getting, it becomes a matter of public interest in the U.S. In Europe. In the U.S., for example, you're not seeing Congress debate how insurers are assigned regulatory capital for their fixed income portfolios as you do with the European legislative body.
Right.
So very different environment, very different equilibrium, and I think it's fair to say that the U.S. System is really evolved alongside with the evolution of capital markets to result in a much richer set of credit holdings, for better or worse.
Yeah, I was going to ask you about the impact of that. Has that been, well, it must be better from some risk perspectives because of the diversification. Is that true?
Right. So if you look at credit holdings, companies in the US, their holdings are much more varied than the ones in Europe. The flip side might be that those holdings are more opaque,
right,
or more complicated, much larger holding of private or credit to private entities with different reporting requirements and the like. So whether there is abstracting for the judgment of better or worse, I think there's a recognition of a cost associated with holding such a wide spectrum of different types of credit whose risk drivers are often very different. But on the other side, as you point out, there's a possible benefit to diversification across those asset holdings. And that the only free lunch out there is diversification, right?
Right. And that level of diversification can mean something because of all the asset owners, insurance companies probably have the longest term of their investments. So diversification, like other things, compounds, right? So
yeah. But on the life side, for sure, right? Their desire to hold long duration assets is they have that appetite, to say the least.
Mm-hmm. Well, now maybe we can pivot to from what has been to what you think will be. Where are the directions of regulatory environments in the U.S. and EU going, and how do you expect those to impact the asset allocation and variety of investments in the future?
That's a good question and a very complicated one. So there's the question of how the NAIC is structured, and an acknowledgement that structure is probably not going to change. Insurers are regulated at the state level. The NAIC sets policy and what's called often model law that the states wind up adopting in some form. Each state often has its own variation in that in the law that's actually passed. So you have the current state right now, which is often viewed as dizzying in terms of the wide range of jurisdictions that insurers have to navigate if they're doing business in different states, which clearly has costs, possibly also benefits, given that different environments often lead to innovation. Right? Rigid systems limit new business models that might benefit the ecosystem. Mm-hmm. Now, let's take a deeper look at the way that fixed income is governed. Fixed income currently is governed under the C1 framework, mm-hmm. the framework that we redesigned in 2021. And it is heavily reliant on NRSRO ratings. Mm-hmm. The NAIC designations that dictate how much capital each credit holding is assigned is really reliant on NRSRO ratings. And there are numerous debates going on right now as far as how appropriate it is to use NRSRO ratings in this way. Okay. Let's just start with an observation. NRSRO ratings, Moody's will describe their ratings as ordinal,
right?
Relative measures,
right?
Capital is what would be referred to as cardinal or a level risk, measuring risk at its level set.
Mhm.
The regulatory capital that is assigned is based off of historic data.
Right.
Right now, it's only based off of corporate default rate data.
Right.
Right now, let's just acknowledge that rating methodologies change over time.
Mhm.
So you're using like decades of data whose relevance is possibly questionable.
Hmm.
And now regulators are starting to appreciate that with the work that we did with them in adopting the 2021 framework.
Okay.
Another thing to acknowledge is that insurers focus on very high grade credit, where default is a remote event. If you're trying to use historic data to assign regulatory capital, one has to acknowledge the limitations of the data that you're actually applying here. Let me share a fun fact. Since 1980, there were only 6 defaults by entities who were rated AAA over the previous 10 years.
Okay.
Now, 3 of those were Icelandic banks. I don't know if you want to think of that as 3 observations in one.
Right.
2 of them were Texaco and Getty.
Right. Right.
That recovery was almost 100%. Fun fact, Gordon Gekko, the famous greed is good character from the 1987 movie Wall Street, played by Michael Douglas, was supposedly inspired in part by the agglomeration of players related to the hostile takeover attempts that led to those 2 defaults.
Right. Okay. Yeah, sure.
Yeah. And that leaves us with Macy's.
Okay.
In other words, it was if you think about the data that goes into estimating a default rating or loss for a AAA rated corporate entity, how much statistical robustness is there to what's being done? Regulators are starting to understand that. They're starting to understand that if you look at historic muni default rates, there's something in the order of 1/10 that of an equally rated Moody's corporate rated entity, right?
Right.
If you look at structured assets, those methodologies have changed markedly since the financial crisis.
Yeah, definitely.
And really haven't been many defaults. Yeah.
Right.
So right now they're trying to understand what's an appropriate approach to level setting risk across different asset classes. What's even possible out there? And if they're going to start with CLOs, what's an appropriate way to think about how risky those CLOs are, recognizing they can't just take historic default rates for CLOs and make inference regarding their risks.
Do you know what the thought process behind starting with CLOs is? Is it because they float?
There are several motivating factors. The use of or investments in CLOs by insurers, life insurers, has grown substantially over the last several years. And that, in part, is observed with many private equity-backed insurers. Mm-hmm. And it's a relatively new business model, if you would, when you think about the history of insurance.
Right.
And if you look at CLOs, if you extrapolate and look at how much holdings have grown, not just with the private equity owned insurers, but across the board, mm-hmm. And you extrapolate in years to come, one could infer a potential risk that one wants to be careful about how to measure.
Okay.
There have been arguments that CLOs in particular exhibit more tail risk. So if there's a downturn and you observe heightened levels of default, CLOs in particular will exhibit pain.
Right.
And so that's created a concern that regulators feel need to be better understood.
Okay. Is there anything like that conversation happening in the EU?
Not to the same extent. The regulation in Europe has insurers really shy away from mezzanine tranches. Yep. And often you even see deals structured in a way that certain tranches are sold to European institutions and then kind of the more senior tranches, and the lower tranches are sold to U.S. insurers.
Right. Okay.
And that's a form, arguably, of effectively playing off of the regulation and the relative burden associated with regulatory capital requirements.
Oh, okay. So let's shift this then to how you think this will cause an evolution in the types or the size of investment products.
Interesting. If we look at the history of how insurance regulation has impacted investment strategy, go back to the rollout of the RBC framework. RBC framework didn't differentiate between single, double, and triple A rated credit. What you saw, perhaps not a surprise, is after the rollout, insurers held more higher yielding single A rated credit, same regulatory capital, less triple A.
Right.
But over time, you also saw fewer triple and double A rated corporate issues. There wasn't as much of an incentive to issue in that space because the market was shifting, because insurers are such a large portion of the market.
Right.
Now, you've seen similar shifts in the marketplace in terms of holdings and then issuance patterns. There was a period where CLOs, for example, had some overlay in terms of the regulation. Now, if history is any indication of what we might see, the new rules that were rolled out in 2021 make triple and double A, for example, more favorable than single A.
Okay.
Right, because it differentiates between ratings in a much more granular manner.
Right.
Presumably, you'll see more triple and double A rated holdings, and hopefully that'll incent more triple and double A rated issues. Now, it was interesting when we first started working on the framework, there were hypotheses that insurers would hold more triple and double A rated structured assets because there's more issues in the structured space. And so just there's available assets to invest in.
Right.
With uncertainty around where regulators are going on the structured side, there is some hesitation associated with investing in that asset class.
Okay.
Although it's still pretty, there's still quite a bit of appetite in that space, given that generally the yields are higher.
Right.
Another dynamic that's playing out is a question of how NRSROs are being treated. The Securities Valuation Office not too long ago put out some statements questioning the comparability of NRSROs.
Right.
And that might have a substantial impact on how they're treated in the context of NAIC designations, which ultimately determine regulatory capital.
Right.
Now, the important nuance there is that rating agencies often specialize in particular segments of the market, whether it's industries or whether it's a type of asset, whether we're talking about structured asset, private placements. And if NRSROs are viewed as not being level set and somehow the NAIC and the regulators decide to go through some notching process, well, that could impact the relative attractiveness of some of these assets. There's an interesting parallel debate going on with the S&P insurance rating, where S&P is looking to possibly notch holdings in their assessment of insurers' creditworthiness in their insurance model.
Right.
And that is, so their S&P is looking to possibly notch issues rated by anyone other than S&P effectively.
Right. And that was really quite a thunderclap in the world a couple of months ago.
Yeah. That is an interesting debate that's happening with folks on both sides having relatively strong opinions.
Oh yeah, I'll bet one side exceptionally strong. Yeah. What else do you think is next? Are there any sort of outlying risks that you imagine could come from this direction in regulation?
Let me make an observation, and really speaks to the complexities of asset classes and capital markets. The SEC that regulates NRSROs it continues to stand behind the need for NRSROs to have differentiated opinions, right? And different opinions is viewed as a good thing. I agree with that. Now, that being said, NRSROs, their ratings enter into regulation, whether we're talking about SEC regulation or insurance regulation. And in effect, that's done because the SEC would need to effectively mimic what an NRSRO does, which is employ thousands of analysts to differentiate credit and assess worthiness. And the SEC would be, that would be incredibly costly for the SEC. It would be incredibly costly for insurance regulators to do something like that. Right? Now, if you think about the challenges that poses in terms of market dynamics, possible incentives by NRSROs to assign their assignment of ratings, how those ratings are used, whether they're being used appropriately, there's a substantial challenge there. Now, from the conversations I'm hearing, the NAIC and the regulators are beginning to appreciate just how rich those challenges are. And the regulators also want to ensure that whatever changes are made don't inhibit business models from entering into the marketplace that may be beneficial to the ecosystem.
Right.
You don't want regulation to just choke innovation, right?
Yeah, that's one of the things that you see has happened in the past, unfortunately, from some regulations. So,
and then those regulations also have an added challenge that they often result in capital flowing towards unregulated spaces.
Right. So the definitely an unintended consequence.
Yeah.
Great. Amnon, this has given us all a lot to think about. I think we should leave it there. Maybe we'll have you back in about 6 months and see how it worked out and have you give another perspective. But thank you for being on our podcast.
Well, thank you, Rob.